Today, I'd like to follow up on yesterday's video. I'd like to thank everybody for the comments and for the views. But we also said yesterday that I said, look, one of the things I'm afraid of is what if they don't buy our treasuries? And why don't we take a look at how we're structured in our financial plumbing that tells us that we may have an issue. So why don't we look at Japan to give us a reference point of how this actually can work over time, okay? So here's the Japanese yen going all the way back. So their suppression began around 1991. So you can see that the yen has been relatively low and relatively stable. Now, for the US government, it's too low and they want it to go up, okay? Then you look at the JGB interest rate over the same period of time. And as you can see, they were virtually, this is the 10 years, so there was about 7 or 8 years there where they had negative interest rates on the short end, okay? So you can see how these two things, so here are the two components of the yen carry trade. That you have a stable currency, big stable currency, and that you have very low interest rates because you're trying to make the difference between, okay? And here is the Japanese debt, and look at where it started to take off, 1991. So they're about, this is 22, so 24, they're about 280% of GDP. Think about America, we're 120, just reference point. And the other thing that I would say, their total debt is over $11 trillion. And so, as we know, that if the Japanese raise their interest rates 1%, okay, that their current annual deficit for the government would double, okay, overnight. If they said today we're going at 1%, it would double because of the interest expense. Now, I know people say that the carry trade is $7 trillion. I think it's 4 to 5. But here's the point. It's 11 trillion and 4 to 5 is the yen carry trade. So what does this mean? What this means is, what's the question? Here's the question. If the yen carry trade unwinds for whatever reason, okay, the yen goes up, dollar goes down, the interest rate change doesn't matter. Here's the question. Will asset managers around the world come in and buy the yen and the JGBs, okay? That's what kept the interest rates low because of the yen carry trade. So would they buy the yen and the JGBs if there's no yen carry trade? My opinion is no, okay? And that would mean for them extremely higher interest rates, maybe even a default, okay? Given that their demographics and everything else, this is definitely a possibility. So, as I've said in prior videos, there's a maybe that Japan will become, in the new world, our new Argentina, okay? So, yes, am I positive on the yen today? Yes, and you saw the reason why. It's been down so long, it's gonna go up, okay? So I'm positive on the yen. But eventually, the yen carry trade will unwind, and if it does unwind, who's gonna buy the yen and the JGBs? Now here's an article on the FT today, and this is why we're doing this, is they say how the treasury market got hooked on hedge fund leverage. Anybody remembers our video from before, we know that in 2007, 8, and 9, the banks had around 55% of the treasury market. Today, they have 22%. The hedge funds were nothing, zero, nothing to even look at. And now they're 20%, a little over 20% of the treasury market, all right? And you can see this reflected in the chart. You can see where what happened to us, on that Monday night, happened to us with COVID, all right? And that's in the middle there. So this has happened before because of the structure of the trade that these guys are doing. So in the article, they're saying that what's going on with the tariffs and all this other stuff has caused a highly leveraged hedge fund strategies to become stressed. These relative value trades usually seek to take advantages of tiny differences between the prices of treasury bonds and various derivative contracts hooked to them. And you can see here, they say even the Federal Reserve has argued that the growth of these leveraged hedge fund strategies, the so-called basis trade, okay, how many videos have we done on that, is a risky development for a market that funds the U.S. government, all right? Now you should stop and read this, but I'll say here, I have pinned on the TikTok 2 videos I did last March and last April, all on this thing with Gensler. This is in the plumbing, and there's a lot of stuff in there. We don't have time for that today, so I would suggest you go listen to them, because this explains what's going on in our markets today because of what's happening. So basically, they were saying, hey, look it, this is getting bigger than big, and we need a solution to this, all right? And the solution was, as they said, that the sci-fis, the hedge funds and the private equity and all these guys, they also have to register with the Federal Reserve and keep cash available to do the trades, because if we're making an offering and they don't come in, then we may tank our offering. So they wanted them to come in. And if you go back and watch my videos, you're going to say, they said, no way. And in fact, they sent a letter to the Fed, the comptroller, and somebody else, it's in the video, saying that, look it, if you don't say that we have to have no capital, zero capital to buy the U.S. Treasuries on auctions, we're not going to participate. You know, if I was the head of the Fed, I'd tell you what I do. But by the way, you're going to find in this article here that we didn't do what we said we were going to do. And there it is at the top of the 3rd paragraph here. However, hedge funds have pushed back on these rules and mostly won. And this, I think, is going to come back and bite us. As anybody knows who's been following me, this senior portfolio manager at Neuberger, he said this is very similar to the UK Minister Liz Truss's ill-fated mini budget and the LTCM collapse in 1998. We are virtually in the exact, that Monday, we are in the same situation as Liz Truss. In the 2nd paragraph, I suggest you stop and read this. The SEC wanted a central clearing rule, and the model in which the third party guarantees every deal in the treasury market would force hedge funds to hold far more cash, reducing the overall amount of leverage in the system. In 2024, the SEC passed a so-called dealer rule, which should have forced hedge funds to register at broker-dealers and subject them to greater regulatory oversight. And they said, no way. So you can see here, they're saying that the hedge funds own $3.4 trillion in 2024, probably a little higher right now. And so everyone admits that because of the hedge funds being in the treasury market, we're going to have a much more volatile market. Everyone knows that. And in fact, we did another video, I'll see if I can pin it to the top, where we said that there was a financial panel that said, hey, we need to develop, Fed needs to develop a way to bail out the hedge funds from their own trade. So $3.4 trillion, go figure. So what does this mean to us, and why do we care? Well, here's the deal. We know that the hedge funds are levered up on this trade 100 times, okay, if not more. And there's 8 to 10, everyone says less than 10, so I'll say 8 to 10 hedge funds. And how much money do they make off of this trade every year? $8 billion. That's right, $8 billion. So the hedge funds aren't going to give this up. They don't, they'll handle the volatility to make $8 billion. And our government is preparing to bail these people out when they make a dash for cash. So when you have the 2,200 point day, what do you sell? Winners, then your underlying, and the underlying is U.S. Treasuries, and that affects our market. So here's the question for us. If we break the hedge fund's connection to the treasuries, will we have enough people buying our treasuries, or do our interest rates go up? Like and follow and tell me what you think.